Get ready. This is Crypto Talk with Mike Willis in 3, 2, 1.
Hello, and welcome to Crypto Talk. I'm your host, Mike Willis. For those of you that don't know me, I spent 30 years as a trader and portfolio manager on Wall Street, and in 2018, I became a Bitcoiner. Each week, we look at crypto, the markets, the news that actually matters. So let's get into it. First up, let's pull up the Bitcoin chart and look at where we stand for this week. For those of you that have been tracking this, we're still in the middle of a crypto winter since last October highs. Hit about $126,000, came all the way back down to 60,000, so a nice 50% retracement. And then it is rallied here 30 to 35% and into the whole Clarity Act bill news that was on the market. And since it passed through it was a sell the news, buy the rumor, sell the news type thing, Bitcoin has pulled back off the $82,000 level. We're sitting about 77,000. I'd still like to point out here that from the high to the low here and these two double tops very closely mirror the 21-22 run up and subsequent crypto winter of 2022. And you can see one of the differences here is we did go down 70% from peak to trough and a much wider U-based bottom here. And typically when you see a steep decline, you're going to get that gives you more of a V-shaped incline. So I wouldn't be surprised if we're off to the races here, but if we're going to track what happened in 2022, plan on a few more months of churning, and you'll be in good shape. It's always a good time to buy Bitcoin. So if we do get to churn for a while here, I would take it as a positive buying opportunity. All right. Now let's zoom in on the 5 key data metrics this week. First up is price and market cap. We're sitting at 77,000 as we talked about. It's been ranging between 77 and 80,000, down from $82,000. We're at a $1.5 trillion market cap. Daily volume is up. It's about 27 billion. Sats per US dollar is 1,288. The goal here is to get that to US dollar parity, which would be a pretty nice return. What that means is instead of 12,000 sats per dollar, it's going to sit on a 1-to-1 parity. That's where we're headed, folks. Money supply, 20 million coins, a little above that, on our way to capping out at 21 million. The fee per block for the last few blocks was 2 sats per transaction. Very low friction. Now let's get into the news. In my 30 years of trading, I can tell you the headlines are constantly changing. So what you have to have is an investment strategy that works over the long term. I always like to ask, what's your crypto plan? Because frankly, most people don't have one. So keep that in the back of your mind as we look over the news for this week. Article 1, SEC to propose tokenized stock framework as Wall Street efforts deepen, Bloomberg. So tokenization is coming to Wall Street. The SEC is preparing an innovative exemption that would allow trading platforms to offer digital versions of publicly traded stocks, and they'd be under lighter regulatory structure and scrutiny. So the DTCC, the NASDAQ, the NYSE, they've been building this infrastructure, and I think you've seen several articles we've pointed out, but they've already filed for certain tokenization of their exchanges, and this particular proposal could arrive as early as this week. Let's dive right into the article. So we have here the SEC could soon introduce a new framework for trading tokenized stocks, according to a Monday report by Bloomberg, a move that may accelerate Wall Street firms to push to bring traditional securities onto blockchain rails. So Wall Street is not fighting crypto anymore. They're actually building it. Newsflash. Bloomberg Law also reported that the agency is preparing an innovation exemption that could allow the trading platforms to offer digital versions of publicly traded securities under a lighter regulatory structure. The proposal could arrive as early as this week, according to people familiar with the matter. So an innovation exemption is a phrase worth paying attention to. That is regulatory language for we are moving fast. Something you normally don't see from the SEC and something that's more than welcome. The effort would mark one of the clearest signals yet that U.S. regulators are warming to tokenized securities, an area where crypto firms and major financial institutions increasingly overlap. So this is the moment TradFi and DeFi stop being two separate conversations. I mean, think about this. You have the New York Stock Exchange, the NASDAQ, other TradFi exchanges that have been operating on 9:30 to 4 o'clock hours for as long as all of us can remember. And all of a sudden, crypto's here, and they fight it and fight it and fight it. And now what you're seeing is a massive shift to where DeFi and TradFi are no longer separate conversations. Pretty exciting. So tokenized stocks are blockchain versions of equities that can trade around the clock and settle faster than traditional shares. Immediate settlement, as most of you who are already using DeFi, in the TradFi world, you at least have a day settlement on things. So supporters argue the structure could reduce settlement delays and make markets more accessible globally. But critics have warned that liquidity fragmentation and investor protections shouldn't be ignored. So around-the-clock trading and faster settlement sounds great until something goes wrong. That's the tension here. So Wall Street firms have moved quickly to position themselves for that shift. The DTCC, which processes the safeguards much of the U.S. securities markets trade under, said it plans to begin limited production of tokenized assets in July. I thought this was all scheduled for 2027. So the fact we're already talking about it potentially hitting in July is ahead of a broader launch in October. The system would allow tokenized versions of stocks and ETFs backed by assets already held within DTCC's infrastructure. So DTCC processes trillions of dollars in securities every single day. When they move into tokenized asset, that is not a test, that's a signal. So in the DeFi world, we talk about protocols. You have the Bitcoin protocol, Ethereum protocol, these are different protocols. The DTCC is the protocol that's the backbone, it's the trading, it's the connecting of the buys and sells, it's the rails of Wall Street. And now you're talking about the rails of Wall Street figuring out how to tokenize traditional TradFi stocks into the digital architecture, it's incredible. This is exciting. So the NASDAQ is also developing a framework for companies to issue blockchain-based shares while preserving traditional ownership rights. The SEC approved the exchange's operators' tokenized securities plan in March. Meanwhile, ICE, the parent of the New York Stock Exchange, also unveiled plans to expand into tokenized stocks, crypto-linked products through a partnership and investment tied to crypto exchange OKX. NASDAQ, NYSE, DTC at the same time, that's not a coincidence. So the combined efforts point to a broader race to modernize the plumbing of the $126 trillion global equity market using blockchain technology. 126 trillion, that's the size of the market they're putting into blockchain potentially. SEC Chairman Paul Akers has signaled support for that direction. As you know, the SEC has been against crypto for years. The SEC chairman changed just last year. Paul Akins took over, very pro-crypto, and we're seeing the results of that. So speaking earlier this month, Akins said the agency is considering formal rulemaking for on-chain trading systems, blockchain settlement infrastructure, and crypto custody models as financial markets become increasingly automated and AI-driven. So the SEC chair is talking about on-chain trading. It's super refreshing. Blockchain settlement, AI, all in the same sentence. That's a very different SEC than the one we've had for the last several years. So Atkins said existing securities rules do not fit blockchain-based systems that combine exchange, clearing, and settlement functions into a single protocol, arguing that the SEC should clarify the rules through regulation rather than enforcement actions. Isn't that a breath of fresh air? So regulate through rules, not through lawsuits. That's exactly what the industry has been asking for since 2017. So the SEC is about to make tokenized stocks a reality. This is not a crypto story anymore. This is a Wall Street story. The same blockchain tech that powers Bitcoin and Ethereum is now going to power the global stock market. The line between traditional finance and digital assets is disappearing faster than most people realize. So let's go to Article 2. Michael Saylor's strategy just bought another 24,000 coins last week, which was roughly $2 billion at an average price of $80,000 each. He's moved up to 843,000 coins, which he's on track for potentially cracking that $1 million number before the end of the year, which would be super exciting. But the reason I wanted to bring up this story, people have been talking about it, and a lot of people have been talking about how Saylor is the volume on Bitcoin. And we just talked about how Bitcoin's volume was, it's been up. Last week it was at $18 billion in a day. This week it was up to $28 billion in a day. So $2 billion of Bitcoin is not Bitcoin's volume. Yes, it can move the market depending on how he goes out there and buys it. But we're talking about $18 to $28 billion a day in the last in the last week of daily volume for Bitcoin. So $2 billion by Saylor, in my opinion, doesn't warrant all the attention it's getting. And remember, he only buys every couple of weeks and sometimes every month or two. So moving on to story number 3, I wanted to talk about Tether froze $344 million in USDT, their stablecoin, across a couple of wallets that U.S. authorities asked them to freeze, and it's one of the largest compliance actions ever. Now, this happened a couple months ago. Well, actually, it just happened 3 weeks ago. But the reason I'm bringing it up now is I want to just discuss for a second the concept that stable coins are US dollars, essentially digital US dollars that can be frozen. So if you have $100 in your pocket, nobody can freeze it. If you have a Bitcoin in your pocket, nobody can freeze it. But if you have a USDT stable coin, it can get frozen. So whether or not in this case it was justified, that's not the issue to me. The issue is, do you want currency that can be shut off at any given time for any given reason? And I'd like to think we can trust the people that are turning off and on that button, but if they can shut it off for the bad guys, we've seen with the different political changes and regime changes in countries all across the globe, and if you pay any attention to history, when the new people come in, the old people all of a sudden are the bad guys. And so one of the things I'd like to point out here is that Trump pledged that the government wouldn't issue its own digital coin. And he did pass that executive order when he got in, and he was true to his promise. But the U.S. stablecoin market is only going to continue to increase. And even though it's operated privately, it's clearly at the beck and call of the powers that be. In this case is a great example of that. So that's all I'd like to say about that. But the story matters because it answers one of the biggest criticisms of crypto, which is that crypto enables criminal activity with no accountability, which I think is not true, because Bitcoin is a permanent digital ledger. It's not anonymous buying and selling. All right, let's go to Article 4. And actually, this is a chart I wanted to share with you. Some of you may not have seen this chart before. It was actually, I was on a Bitcoin meetup group yesterday, a Tampa group, and one of the guys pulled up the long-term power law. I actually hadn't seen this before. If you guys have, you're one step ahead of me, but you have a logarithmic scale on both sides of the graph, not just on the price side, but also on the date side. And you can't help but look at this chart and marvel at the bottom line, the red line down here, and Bitcoin has bounced off of it every time. And remember, this is a lot different from the chart we looked at the beginning here. This is a true chart of Bitcoin, not using logarithmic scale. So you have these massive ups and downs. But by using logarithmic math, the long-term power law, and you can look into the exact formula for it. We don't need to go into that now. But just know that it's produced a very consistent line from 2011 as a baseline for what Bitcoin bounces off of, and we just bounced off of it. So I think it's pretty compelling, and I thought I'd just bring it up. You guys look it up if you want to take a look at it a little closer. All right. Well, most of you know this Friday is the anniversary of it's Pizza Day, and May 22nd, 2010, a Bitcoin miner paid 10,000 coins for 2 large pizzas. And at that time, that was worth about, it was just a couple dollars. And now, at least at Bitcoin's peak in October, that was over $1 billion. So he's been, I think his name is Laszlo, and he's been interviewed, almost every year since that time, asking him if he regretted it. But I think he also appreciates as being part of the new Bitcoin super economy, which is he helped lay the pavement for. So this story is not really about pizza. It's about how early we still are. The man who made the first real world Bitcoin transaction in history did not regret it, because at the time Bitcoin had no value. He was just happy his hobby bought him dinner. Now, this is the nature of a new technology. Nobody sees it coming. The people who bought Bitcoin at $1 thought they were getting a great deal. The people who bought at 100 and at 1,000 and now 10,000 thought the same thing. The question worth asking yourself today is, how will you feel about the price you paid for Bitcoin in 2024? In 2040. Go. Well, we got to change that.
No,
Okay.
Just roll with it.
Okay.
Just correct yourself and roll with it.
Okay. Those are the stories on my radar this week. Now, let's get into the TradFi versus DeFi numbers. I like to point this out because when we step back and take a look at the broader market, you have to keep in mind that anything happening in traditional markets will influence the crypto space. So let's pull up the S&P and see what's happening in the traditional markets. So for the last week, TradFi was flat. Bitcoin was down about 2.5%. The last month, TradFi won again, up about 4 to 5%, with Bitcoin up around 2%. For the last year, Bitcoin's up around, or S&P's up around 26%, and Bitcoin's down 28%. The spread there is massive. That's over a 50% spread between TradFi and DeFi. So TradFi is trouncing DeFi at least over the last 12 months. And then when you look at when you kind of zoom out, look at the longer picture, you can see why Bitcoiners are still happy and smiling that they own Bitcoin, because over time, and at least over the last 10 years, it's proved to be the one of the best performing asset classes that has ever existed. So that's the macro picture for this week. Now let's wrap it up. So 30 years on Wall Street has taught me a lot of things. But here's what this week reminded me of. When the internet was first commercialized in the 90s, there were millions of domain names available. You could register any name you wanted for $10. Most people thought it was a novelty. A few people bought every domain they could get their hands on. Business.com sold for 7+ million. Sex.com sold for 13. I know Voice was a Saylor thing. He sold it for, I think, $30 million. AI.com just sold for 70 million. Anyway, in 1999, it had just come out, and it's like buying Bitcoin at $1 or 10 cents. You could buy these domains for $10. But some people had the foresight of looking in the future. They understand something everyone else missed, that digital real estate is scarce, and once it's gone, it's gone. So Wall Street is registering its domains right now, and there's only going to be 21 million coins. The institutions are warming up to it. The regulators are finally allowing it. And 16 years ago this week, one man bought 2 pizzas with 10,000 Bitcoins, and it would be worth almost $1 billion right now. But he's still glad he did, because he helped launch a digital giant that hasn't looked back. The question isn't whether you understand Bitcoin. The question is whether you understood it early enough. Those who act now, when it's still early, these are the people that benefit the most. And on that note, we are wrapped for this week. I'm Mike Willis, and remember to keep one eye on Wall Street and 2 on crypto.
That's Crypto Talk with Mike Willis. We'll see you next time.